Welcome to the deep dive. We're diving into some fascinating stuff you sent our way. It's all about fixed income investing and specifically bonds.
Yeah, bonds.
Yeah, so we're going to, really unpack all this material that you've shared and hopefully extract some of the golden nuggets to help you get a grip on bonds and, maybe see how they could fit into your financial strategy. So, at a basic level, how would you describe a bond to somebody who maybe they've heard the term, but they don't, they couldn't really explain it to their friend?
Well, I mean, at the most basic level, a bond is a loan, right? It's you're lending money to a company or a government.
Okay.
And in exchange for that loan, they are promising to pay you back that money with interest.
Yeah.
And that interest comes in the form of regular payments over a set period of time. And then at the end of that period, you get your initial investment back.
So there's like a due date.
Exactly.
Okay.
And that due date's called the maturity date.
That maturity date. All right. So I give them the money, they pay me interest, and then eventually I get the money back on the maturity date.
Yeah, that's the basic idea.
All right. So why would I, as an investor, why would I want to buy a bond?
Well, there's a couple of reasons. One of the things that people like about bonds is that they offer, generally speaking, they offer a more predictable income stream than something like stocks.
Okay.
Right?
Like a steady paycheck.
Like a steady paycheck, yeah.
Yeah.
You know that if you buy a bond with a certain interest rate, you're going to get those interest payments on a regular basis.
And your sources really seem to position bonds as the sort of stable foundation for a financial plan.
Absolutely.
Like the unsung heroes, they say, of investing.
Yeah, we often hear a lot about stocks and the potential for high growth with stocks, but bonds really play an important role in sort of balancing out that risk.
Okay, so if I decide, all right, I'm sold, I want some bonds, who do I actually buy these from?
Well, there's a few different types of bonds. You can buy bonds from governments.
Okay.
And those are called government bonds.
Oh.
And you could buy bonds from municipalities.
Municipality. So that would be like like a state or a city?
Yeah, a state or a city.
Okay.
And you can also buy bonds from corporations.
Okay, and so those three buckets, governments, municipalities, and corporations, they each issue bonds, and I can choose which ones I want to buy.
Exactly.
Okay. So what are the key differences, I guess, between the bonds issued by these different, issuers?
Well, I mean, one of the biggest differences is the level of risk.
Okay.
So generally speaking, government bonds are considered to be the least risky.
Okay, so less risky. Why?
Well, because they're backed by the full faith and credit of the government.
Okay.
So, in the case of the U.S. government, the government has the ability to tax. Yep. So they can always raise revenue to pay back its debts.
Okay.
So that makes U.S. government bonds very, very low risk.
So those would be like the safest bet, like the treasury bonds.
Yeah, exactly.
Right.
Treasury bonds are a type of government bond.
Okay, and then what about the municipal bonds?
Municipal bonds are also generally considered to be pretty safe.
Okay.
They're backed by the taxing power of the municipality.
Okay.
But they do carry a little bit more risk than government bonds.
Okay, a little bit more risk.
Just because the financial health of a municipality can vary.
Okay.
Right.
Yeah.
And then corporate bonds are generally considered to be the most risky.
Okay, so corporate bonds are the riskiest.
Yeah.
Why are they the riskiest?
Well, because the financial health of a company can vary a lot.
Okay.
Right.
Yeah.
And companies can get bankrupt. And if a company goes bankrupt, then you may not get your money back.
Right. So it's kind of like if you're lending money to your friend, hopefully they'll pay you back, but there's a little bit more risk there.
Right. Exactly.
Than if you were lending money to, the U.S. government.
Exactly.
Okay. So then, given all of this risk, what are some of the things that investors look at when they are trying to decide, which bonds to buy?
Well, one of the things that they look at is the credit rating.
Okay.
So credit rating agencies like Moody's and S&P and Fitch, they rate the credit worthiness of different borrowers.
Okay.
And those ratings basically tell you how likely it is that the borrower is going to be able to pay back its debts.
So it's like a credit score? kind of?
Exactly, yeah.
All right, so the higher the credit rating, the lower the risk.
Exactly.
Okay, so I'd want to look for bonds with higher credit ratings because that means they're less likely to default.
Yeah.
Okay, so that's one thing that they look at. And then what about this whole thing with interest rates? Because everybody talks about interest rates going up, interest rates going down. How did that affect bonds?
Well, that's one of the interesting things about bonds is that the price of a bond um, is actually inversely related to interest rates.
Inversely related. That sounds a little
Yeah.
confusing.
So basically what that means is that when interest rates go up, the price of a bond goes down.
Okay, and when interest rates go down, the price of a bond goes up.
Exactly.
Okay, I don't get it. Like why would that happen?
Well, so let's imagine that you buy a bond when interest rates are low.
Okay.
So let's say you buy a bond that pays a 3% interest rate,
Uh-huh.
and then let's say a couple of years later, interest rates go up.
Okay.
So now new bonds are being issued that pay a 5% interest rate.
Okay.
So if you wanted to sell your bond that pays a 3% interest rate, you would have to sell it at a discount because nobody's going to want to buy a bond that pays 3%
Mm-hmm.
when they could buy a bond that pays 5%.
Right, right, because they can get a better deal now.
Exactly.
Okay, I see. So the value of my bond that I'm holding goes down because there are better deals out there.
Exactly.
Okay. And vice versa, if interest rates went down,
Yeah, if interest rates went down, then your bond would become more valuable.
because it's offering a better return.
Yeah, exactly.
Okay. So there's a lot to keep in mind with interest rates. That's a really important relationship.
Yeah, it definitely is.
Okay. Now, your sources mentioned the strategy called bond laddering. What is that?
Yeah, so bond laddering it's a way to sort of manage your interest rate risk.
Okay.
And basically the way it works is that you buy bonds with different maturity dates.
Okay.
So let's say that you have, $10,000 to invest in bonds.
Uh-huh.
You might buy $2,000 worth of bonds that mature in 1 year,
Yep.
and then $2,000 worth of bonds that mature in 2 years, and so on and so forth.
Okay.
So you're basically creating a ladder of bonds.
The ladder.
Yeah,
Okay.
with different maturity dates.
Got it.
And the advantage of doing that is that it helps you to smooth out your interest rate risk.
So it's not all coming due at the same time.
Exactly.
Okay.
So if interest rates go up, you're not stuck reinvesting all of your money at a higher interest rate.
Right, right. You've got some coming due at different times.
Exactly.
Okay. That's a pretty interesting strategy.
Yeah, that's a popular one.
Now, all this talk about bonds, it sounds pretty modern, but your sources actually mentioned that the first recorded bond goes way, way back.
Oh yeah, it goes back to ancient Mesopotamia.
Ancient Mesopotamia. That's crazy.
Yeah, around 2400 BC.
Wow.
There's evidence of a bond, basically a loan agreement that was written on a clay tablet.
Wow, so the concept's been around for a very long time.
Oh yeah, yeah.
Now, your sources also mentioned this really interesting fact about the size of the bond market compared to the stock market.
Yeah, a lot of people don't realize this, but the global bond market is actually much larger than the global stock market.
Much larger.
Yeah.
So why do you think that is?
Well, I think it's just because there's so much demand for bonds.
Mm-hmm.
Bonds are used by governments to finance their operations. They're
Yeah.
used by corporations to raise capital.
Okay.
And they're also used by individuals to save for retirement.
Yeah, it's a huge market.
It's a huge market.
Now, speaking of huge figures in the bond market,
Yeah.
your material mentioned this guy, Bill Gross, who is dubbed the Bond King. Can you tell us a little bit about him?
Yeah. So Bill Gross is a legendary bond investor.
Mm.
He was the founder and the chief investment officer of PIMCO,
Oh, yeah.
which is a very large bond investment firm. And he's really credited with sort of revolutionizing the way that bonds are traded
Okay.
and managed.
Really changed the game.
Yeah, he's a really, really influential figure in the bond market.
So we've talked about a lot here about bonds, different types, different issuers, interest rates, credit ratings. What would you say is the single most important takeaway from all of this information?
I think the single most important takeaway is that bonds are really a key part of a well-diversified portfolio.
Okay.
They can help to reduce the overall risk of your portfolio.
Okay.
And they can also provide you with a steady stream of income.
So it sounds like it's really not just about seeking a big return. It's about creating the stable foundation for your financial future.
Exactly.
So how does all of this connect back to our listener who is, maybe they're just getting started with investing, or maybe they're looking to, add some more knowledge to their repertoire?
Well, I think it's important for everyone to understand the basics of bonds,
Okay.
because bonds are such a major part of the financial system.
Uh-huh.
And even if you're not planning on investing in bonds directly, um, it's helpful to understand how they work,
Right, right.
because it just gives you a better understanding of the overall financial landscape.
So, maybe somebody is listening to this and they're thinking, "Wow, there's a lot to learn about bonds." Where would you recommend, if somebody wants to go deeper, what are some resources that you would point them to?
Well, there's a lot of great resources available online. There's websites like Investopedia and Morningstar
Okay.
that have a lot of good information on bonds. You can also, talk to a financial advisor
Aw.
who can help you to understand bonds and how they might fit into your overall financial plan.
Okay, so there's a lot of resources out there for those who want to learn more, and you're right, it is a pretty complex world. So we've covered a lot of ground here, but we've just scratched the surface. There's so much more to learn about bonds, and how they can be a part of a successful financial strategy.
Yeah, it's a fascinating subject.
It really is. Well, this has been a really interesting deep dive into the world of bonds, and thanks to you, I think we've been able to extract some really valuable insights from this material.
Glad to help.
So, as you continue your journey in the financial world, I encourage you to keep learning. Do your research, ask questions, and don't be afraid to seek out expert advice when you need it. Because at the end of the day, the more you know, the better equipped you'll be to make informed decisions and build a secure financial future.
Couldn't have said it better myself.
Well, that's all the time we have for today's deep dive. Thanks for joining us.
It's been a pleasure.
Until next time, keep exploring and stay curious. And remember, the journey to financial well-being is a marathon, not a sprint.
Well said.
Take care.